Hello, what's up, guys? Hope you're doing well. I am Haya, and I'm back with a new video which is going to be about sustainability reporting and what will be the questions expected in SBR exam out of it. And this is going to be about decoding a technical article related to that because this is not a textbook type topic, where you read the textbook, you read the IFRS standard, you understood the concept, you saw all the test your understandings that you're good to go. This is not some calculative area as well. It's more theoretical, and there is some general IFRS standard applicable to it. Like there is no specific IFRS standard for the climatic area. It's more like how it affects different areas of the financials, different areas of PPE, impairment wise, or depreciation wise, and useful life effect, or inventory wise. It's more like how it is correlated to other standards, and secondly what kind of disclosures are required. It's just going to be that no one's are going to ask you to assess the environmental impact and become that valuation analyst or some technical person who will do the figure out how much where the environment costs and all. No one's going to expect you to do that. So remember that first, guys. So let's get started, not wasting any more time, because I heard some feedback from various students that I should cover topics like these also, and these are current issues. These do not have many, like only in the recent papers these questions are started. Like back in 2021 when the standard came up, only after that the papers cover this basically. So I thought let's just let's cover the standard and the questions associated to it. So let's get started. And if you find any part useless, like I'm like sometimes stopping, my computer glitches in between or something like that happens, you can forward that part. It's okay because I'm not going to edit it much. I just want to make it as short as possible and make it easy for you, simple for you. So let's get started. Let me share my screen. Let me just share my screen. And there we go. So I'm helping you navigate to the article as well. So it's just the technical articles page of ACCA. First we go there. See, there's cryptocurrencies and all about the, expected topics that will be tested in third, fourth question of the SBR exam. So please know about this. The impact of changes, yes, sustainability reporting standards. So any potential changes and all that. So basically why it's saying this, because these standards keep changing. These standards keep updating, and plus like 2021 only this S1 S2, the sustainability related ones have been introduced and all that. So let's just cover that in detail and understand what is going on and stuff. First of all, this is where it is. So if you want, after this video you can read. I'm going to decode this entire thing for you. I want to make it easy for you, and it's not hard, to be honest, guys. You just have to know how to answer this. So in the kit everything is provided. It's just that sometimes people don't know how to use it, but it's okay. I'm there to decode that as well. So candidates will need to be able to use their knowledge of IFRS S1 and 2 assess disclosures of climate related, etc. So how much disclosure is required? Whether it is material enough to be disclosed or whether it is not. General stuff will be tested, guys. And you will have the correct number of marks also. Like there'll be 7 marks given or 5 marks given or how much ever will be expected out of you. Like, it's going basically just going to be investors and what do they expect out of people. So out of the organizations, how are they meeting the standards, how are they meeting the government targets, or they'll be afraid of about their investment, something like that, something around this always. So just be aware of that. And the article highlights some of the key principles within IFRS S1 S2, which will be, yeah. So this is very important article, guys. Cryptocurrency also I have covered. I have covered stuff in my reels also, Instagram reels also. Genuinely, guys, I'm giving you content which will help you get easy marks in your hand. Get easy marks in your hand, and you don't even have to worry. All you have to do is follow me, guys. So the more you encourage and support me, the more I can give you what you want. The marks, the support, right? So you have to help me out, guys. Really, I'm telling you. So I have covered on all of this, and I also covered on what are the requirements of various shareholders, uh, like disclosures or interpretation of financial statements. That topic also I've covered. Please check my past videos, guys. I've generally spent hours on that. So in recent years, there has been a growing awareness of sustainability related risk and the potential impact. Yeah, what impact it has financial statements, increasing voluntary reporting has caused fragmentation, and this has limited the usefulness of the information provided. So prominent the provision of different voluntary reporting and has caused fragmentation. Yeah, basically like there are different frameworks, different jurisdictions follow different things, different Some people do it voluntarily. Some standards are not important for people. Some standards are important for organizations according to the laws, according to whatever. So even this is like was to even this is voluntary, to be honest. Like, this is not like heavily followed by all the organizations, although it is getting important now, of course, whoever is following IFRS standard. But whoever is not following IFRS standards does not have to necessarily probably disclose about this. However, even other accounting standards are adapting to this, so we need to be aware of about that fact, and we need to be aware of how to do the accounting for it. So the IFRS Foundation believes that the information needs of investors were not being met. In response, they founded the IASB, which has the aims of yes. In 2023, the IASB issued its first two disclosures. I'm sorry, 2021, it was just a discussion. 2023 is when they have actually done it. So sorry about the year, guys. So IFRS S1 general requirements for disclosures. So this is general, and another is climate-related disclosure. Two categories, guys. These two standards are included on the list of examinable documents for SBR exams from September 24 onwards. So, although I would say that past papers, somewhere or the other, it is partially there, I would say, but maybe it's more like specific to this standard, specific to the testing of S1 and S2. The wording in these, the testing about your knowledge related to these will be there. We'll see how it is exactly going to be there. So entities apply IFRS S1 when preparing and reporting sustainability related financials. IFRS S1 refers to the areas of co-content that entities should provide in their sustainability related financial governance used to monitor and manage sustainability related. The approach to managing sustainability related strategy, risk management. How are you assessing? How are you monitoring? How are you reacting to it? And the entity's performance in relation to sustainability related risks. How well are you meeting the KPIs related to sustainability. So these are the categories that IFRS S1 relates to. And entities must refer to what they issued when disclosing information about specific sustainability. And this means that entities must use IFRS S2 when preparing disclosures of climate related risks and opportunities. So it's like, if it's about disclosures, and that too not specifically climate, about sustainability. Whenever people use sustainability, they often interchange with climate, but climate is not the only thing that is included in sustainability, guys. It can be much more. It can be resources as well. It can be those non-renewable resources as well. It is sustainability, guys. It's about the long term, basically, and ethics. So it is a mixture of both of them. So it can't be climatic alone. Climatic has a separate standard. So please, first of all, understand the difference. As no for the IFRS standard disclosure standards have yet been issued, sustainability related disclosures related to non-climatic issues must be prepared using the IFRS. Yeah, exactly. That's what I'm trying to say. Non-climatic means IFRS S1 only. So ISB will eventually draft, consult, issue suite of other sustainability disclosure standards, but in the meantime, requires users to consult disclosure covered in these standards issued by the sustainability uh, and to assess whether they are applicable. Exactly. So S1 is basically the one that is supposed to be followed for all except climate. IFRS S1 does permit entities to omit information about sustainability data from sustainability related financial disclosures if the information is commercially sensitive. Okay. However, the exemption does not apply to any information that's already publicly, neither does it apply to sustainability related risks. So basically, like, for example, if it is something related to their strategy that could give a competitive advantage over others, you know, if they don't want to disclose that, if they don't exactly want to disclose their strategy, it's good, it's fine, it's their choice. But provided they should, how well are they meeting their current KPIs, they should provide some idea regarding it, right? If it is, and plus if it is already publicly available, they are not supposed to, like, they can't give the idea that, of course, if it's already publicly available, that means anyone can already access it. It's already out there. There's no point of hiding it from your financials anymore. So you would have to disclose the information which is already publicly available. So it's just saying that. So there are several sustainability related risks, right? So it's also saying that if there is a risk that you won't be able to meet a target, if a government has set a target and you're not going to meet it, and you're going to, penalty is going to be there and all that, even in that case, you can't say that I'm not going to disclose my strategy, because that time investors will require your financial statements the most. That time they will ask for the strategy that you're implementing to overcome the risk or at least reduce it to some extent. Even then you will be like, I don't want to care about my competitive advantage. I want to care about how I win over the competition. I don't want to disclose my strategies because others will copy. Then that's not how it's going to work, right? You have to think about investors and their wealth in us, invested in us. So there are several similarities between the principles and concepts in IFRS disclosures and IFRS accounting standards. So yes, basically it's like amalgamation of both. And let's see how it is. So there are several, yeah, both sets of standards use the same two fundamental characteristics of useful information. Exactly. So we have studied this back in FR exam itself. The guidance behind the the use of IFRS standards, the guidance behind defining a financial item, whether it's asset, liability, expense, income, whether it should be included in the financials or not. What is materiality? What are the fundamental principles? All of this we have learned already. So this is what it's trying to compare and figure out. This is not going to be tested, guys, but at least you should be able to define what is materiality and why it is important. What is materiality and why it is specifically important to disclose about a particular sustainability standard. So that's how it is. So both sets of standards use the same two fundamental useful, relevance and faithful, as well as the same for enhancing qualitative. Yeah. So definition of materiality across the two sets of standards is also the same. Information of yeah. So again, if you are asked in the question, I'll cover a question where they are specifically asking about materiality part. So why exactly is it important in the scenario to cover the materiality? You can answer that part, um, because of so and so reason. It's actually common sense based. I already gave you the reasons. Like investors will only be interested to be a part of you further if you have that reputation out there, if you are caring about the long term, if you are caring about sustainability of the firm, if it is likely that people are not going to hate you as an organization, or if you are meeting the standards set by the government. There's so many things out there, guys. So it's all common sense. It's just the way you have to write is what affects, right? So both sets of standards identify the same primary use of functional financial reports, current and potential investors, lenders, and other creditors. IFRS S1 specifies that sustainability related financial disclosure must be reported at the same time as the later financial statements. The reporting period for the sustainability related information must also be the same as of the financial statements. Exactly. Both sets of standards require this disclosure of comparative information. That means, every financial statements, if you have seen some 21, this year, for example, it will be 24 and 23. If considering the last financial year, it will be 24, 23, because till now 2025 is not over. If you're following any financial year end, 25 is not over. Anyways, what I'm trying to say is both the past financial year also and this financial year also will be covered in the financials. So similar thing will be applied for sustainability disclosures also. You're going to have a comparative figure from last year as well, which is unlikely to be changed because if, for example, if there's no significant change that has or there's no adjusting event that has taken place, provided that is the case, then you don't have to necessarily change it. Then you Yeah, then you don't have to necessarily. So the treatment of material prior period errors and sustainability related financial is also based on the same principles as in IFRS. These errors must be corrected retrospectively by restating. Exactly, that's what I was trying to say. Unless it is impractical. So, for example, the valuation person who had valued it, he maybe he did not follow the correct standards. Something happened, something went wrong. There was an error, prior period error. So the same thing that's covered under the IFRS standard about prior period errors, adjusting, restating, all of that, restating the opening equity and all. Same applies for sustainability as well. We'll have to restate the opening balance of that as well, correct the 2023 balance, and go ahead. And if I remember, IAS 8 is the one covering it. So which one is it? IAS 8 or IFRS 8? Yeah, yeah, it's IAS 8 covering it, guys. So, climate-related disclosures, risk and opportunities. The SBR syllabus for us onwards requires candidates to assess disclosures of climate-related risk and opportunities, apply IFRS S2 when producing climate-related disclosures. The purpose of these disclosures is to provide information about climate-related risk and yeah, same thing again and again. Physical risk and transition risk. Physical risk such as floods or droughts. They are, they also result from longer term calamity. For example, rising may lead to rising sea levels as well as loss of biodiversity. And transition result from the moves towards a lower carbon economy. So it's like, physical is probably an event that has taken place, an unfortunate event that has taken place, which is not under the control of us and all that, right? What we just read. However, transition is more like how we are transitioning to a better economy, sustainable economy. We are taking measures to, improvise green, green energy using electrical vehicles and so on, whatever. So entities are required to provide disclosures about its governance so that the users of financial reports can understand how climate data is kind of identified, monitored, and managed. When identifying systematic risk, entities must use all reasonable and supportable information that is available to them without undue cost of effort. And data sources can be internal or external, might include risk management process, external reports, and industry experience about because of change over time and depend on the benefits of the information provided to the users. So will change over time. Yeah, so basically, they're trying to say it should not cost undue cost. It should not cost them a huge amount, which is not reasonable. How much ever information they have, which is reasonable for them, to support in their disclosures related to the, you know, in identifying, in taking measures, in including about the risk management process, how they have addressed the risk and all of that. That is more than enough. You don't have to spend extra, go beyond irrelevance basically to able to to be able to disclose it to be able to probably what we say to disclose information for investors. That's what. So the following is an example of a disclosure of some of the climate-related risk and opportunities facing an international restaurant business. So this is giving an example as well for us. Let's just read what are the relevant metrics and all that. Okay. So see, guys, don't get scared of the metrics. First question I would like to raise. I don't know, people just get scared of metrics and they're like, where do we include that? Which one of the financial statements? It's not about financial statements, it's about disclosures here. How much you have to disclose, how material it is to disclose, it's going to be more about that. So please remember that. So the following is an example of disclosure some of the climate related and physical risks. Increased levels of flooding due to climate has affected the quality, leads to price volatility, which reduces profit margin. Restaurants price. Oh God, I don't know. I'm reading so fast. Restaurants in some locations are heavily impacted by water shortages and chronic. These events may cause revenue, but they can also increase the cost of insurance premiums. Okay, transition there's a regularly changing and institutions operating in more than 90 countries around the world. Increase can result in higher operation in relation to cost of energy. So these are regulations that see what it's trying to say is what it's trying to say is it's giving you a live example of how it has disclosed. Okay, what is exactly causing them to record or to first of all identify what is the risk. So and so happened, this is our business model, this thing affected the business model like that. There was a climate change due to levels of flooding, this affected quantity and therefore price volatility happened and then reduced profit margins. This is an important information for investors, of course, because included when they have to analyze the financial information, they will be interested in your business. So they want to know what exactly impacted, how exactly did it impact, what exactly happened, right? That full information is properly disclosed here. And here is the example of a physical risk. Restaurants are heavily impacted by water shortages. Yeah. So this is also saying what is going to happen possibly, what will be the possible impact in the future. It's a good thing, you're going one step ahead. You're also writing insurance premiums are also likely to increase. This is what happening to all in the sector. You can make a comparable analysis also as well. You can make a comparable analysis with last year as well. Last year this was not the case, but this year this is the case. You can probably make a variance analysis and all that. Even the auditors will ask you for that actually, that what exactly happened, why your costs are so high, why your insurance premiums are so high this year, why your other costs are so high this year, what exactly has happened. You can make a variance analysis for them as well. But nevertheless, what I'm trying to say is you are trying to say what exactly happened, what was the impact, and potentially what will be the impact in the future as well. So similarly, transaction risks also, you're trying to say that they are regularly changing, laws are regularly changing, compliance costs are high. You know, uh, why you don't have to write why the laws are changing. You can just say this is a law that's being, across the world, across the industry, it is being applied. And if you do not meet them, you are going to lose your brand value, and at the same time, that will impact the market share, market price. You can mention market, you can mention micro, how it will affect macro, how will it affect against the what we say competitors and so on. So that's your choice. But in short, you want to make sure that it is, sorry guys, in short, you want to make sure that how exactly it is going to affect you compared to others. If you, the more you show that, the more you show how if it will affect you in the long term as well, in the short term as well, the more clarity the investors will get. Okay, this is how the effect is going to be. Okay, fine. They will then assess whether they should further keep their investment or they should let it go, or they'll make a reasonable decision. It's just you have to be transparent enough. That's all. Then, with regards to identified risk and opportunities, entities would need to disclose the impact on its strategy and decision making. It must outline the effect of the risks and opportunities on its financial position, financial and cash flows in the current reporting as well as in the yes. So, resilience of the entity strategy. So, basically, now that this has happened, what is the entity going to do? How resilient they are to such risks. Okay, for example, this event has taken place. One cyclone has come up, and the business is very badly affected. It was a shop and completely destroyed, and all of that. What will they do now? They're not shop. I mean, let's say lots of businesses out there, like malls and all of that, and all of them got affected, and so on. The businesses got affected. Now, what is their strategy, right? And how are you going to adapt to it compared to other competitors who are in the similar industry, who are also owning malls and all that? So, what I currently said, short, medium, long term, everything is going to be covered. Okay, guys. So I'm not going to repeat it again. It's just going to be boring then for you. Then, in accordance with IFRS, are required to disclose gross GHG gas emissions. So GHG is greenhouse gas emissions and all that. Now this is becoming more specific. Okay. So, and this is a helpful information, guys. The more you know about greenhouse gas emissions and such specific topics, the more it will be easier for you when you read the paper. If you don't read this technical article or if you don't watch this video, you're going to suffer, guys, because there will be, it is clearly mentioned about, there will be testing in this topic. If it is mentioned and still you're not doing it, then I don't know what are you doing, guys. Seriously. So entities are required to disclose metrics and targets that will help primary user understand its performance relation to climate related affairs as not in climate related that an entity has set, as well as information about its greenhouse gas. Yeah. So any targets, how it is meeting them, or how much, what is the progress towards it, all of that. So disclosures, they have given scope 1, scope 2, scope 3. Direct GHG emissions that occur from sources that are owned or controlled by the entity. Indirect GHG from the generation of purchase of acquired electricity, say, or cooling consumer entity, not including scope 2, that occur in the value chain of an entity. So something that is under their control, climate change, or what we say, sorry, GHG emissions from there. GHG emissions from stuff which are not directly in their control, which are technically related to business operations, indirect expenses and all, we make utilities related. It's coming from there. Probably not entirely controllable for us, or we don't really know, but yeah, it's not maybe it is genuinely required for the business. And lastly, in the value chain, for example, if it has something to do with the suppliers from where you buy, if their methods are not sustainable enough, they produce a lot of emissions. For example, they use vehicles, which are not, like, of course, energy efficient. They don't use electrical vehicles, or they don't follow sustainability practices and all that, which are going to cause carbon emissions or something. So that is something that's not under your control, but that is a part of your value chain. So that is scope 3. Okay, so these are the 3 scopes that we need to be aware of. Okay, guys, and questions can come under each of these categories. And what will be our disclosure requirement under each of this thing is going to cover now. This is where we are getting more specific into this, guys. An example disclosure of gross GHG is provided below. Scope 1, okay, this is there. Metric ton, okay. this, okay, then this GHG emissions to this is a comparability analysis, like comparable from last year and all, everything will be disclosed. So this disclosure is important because it helps users of the sustainability entities exposed to climate related entities with higher GHG are potentially more exposed to climate, of course, yeah, related answer, because they will be more heavily impacted by the legal and in particular shifting into severe if our entities not make sufficient progress in reducing the area. So basically they're trying to say that the more you are not, the more you have GHG emissions, the more it's likely that you are at a reputational risk, or you are at a risk of legalities where people will file against you, communities will file against you, or if you're not meeting the laws, not meeting the law targets and all, of course penalties will be coming over you. You will have to apply I-37 provisions, making and all of that, and of course that's a lot of costs, legal costs out there. For some industries, Scope 3 emissions can account for almost 90% of the total. For the reason, Scope 3 emissions are sometimes perceived as hidden risks, especially if undisclosed. The requirement in the IFRS to disclose Scope 3 GHG emissions therefore gives a more complete picture of an entity's overall carbon impact, and it also enables investors to compare the carbon impact of entities which with different business models, such as those which heavily outsource activities and those that do not. It's something that is not in the control of the firm, guys. Whatever is controllable are very few of them, but whatever is in the value chain has a lot of suppliers, a lot of businesses out there. So it is large. It's broadly quite large, right? And that's why it is going to cover 90% of the total GHG emissions that the firm has recorded in the disclosures, right? Are sometimes perceived as hidden risk, especially if undisclosed. So sometimes, of course, since they're not in our control, we might not have some metrics. Firms might omit or they might not disclose it in the first place. So that is where the hidden risk lies. If they fail to account for it, if they fail to estimate it, find a proper estimate, a reasonable estimate which actually reflects the figure, that will, of course, lead to a hidden risk. And it's like investors will be in cloud nine if they, or it will be like a bubble for them. And the bubble will burst, of course, if when the government gets to know that the firm has not fulfilled the targets that they have set in reality. So that's what I'm trying to say. The requirements in IFRS S2 to disclose, therefore, gives a more complete picture of an entry's overall carbon gap. So scope 3 is what covers that. Scope 3 in IFRS S2 is specifically going to say that, okay, we understand that you have a value chain as well, which is, of course, not in your control, but you will have to disclose related to that as well. Whatever possible estimate, hire an expert, figure out, do a lot of research out there, but disclose about that as well, because that accounts for 90% of the entire risk related to sustainability, related to climate related disclosures, climate related targets, sorry. So you need to disclose about that. And at the same time, of course, because of this, they will be able to compare the carbon impact of entities with different businesses out there in the industry and all that. You know, yeah, this is just an example. But whatever it is, it's just that scope 3 specifically covers a lot. And scope 3 covers the main part, the 90% of the risk. So it can be difficult to measure GHG, particularly those falling into scope 3, and many different methodologies exist. For this reason, IFRS 2 requires entities to measure GHG according to the greenhouse gas protocol or corporate accounting and reporting standard, unless an entity is legally required to use a different method. This consistent approach reduces the risk of bias, helping to ensure a faithful representation of underlying phenomena. There are also some exemptions simply for entities in the first year of applying IFRS S2. Yeah, of course. So, faithful representation, whatever is the other, generally whatever IFRS standards, whatever principles are required for that, that is being followed here. Fine. If you want to read more about this, you can read more about this accounting standard, but it is unlikely that it will be tested for you guys. Like, I don't think it will be. And different methodologies do exist. Methodologies exist. Again, nobody's expecting you to, apply those methodologies or find out how much exactly is supposed to be estimated in the disclosures, right? Um, for some entities, maybe for SMEs or some, it depends on the jurisdiction. They might not have to disclose, or maybe if it's a government entity, they might not have to disclose, or something like that. It really depends. But if you are disclosing it, it's better. But if you have got exemptions, of course, you can exercise it, because you can exercise it, but if you want more investors, if you want to issue IPOs, if you want to issue shares, get more financing, get more reputation, get more private investors also, you have to be a bit more diligent, and maybe you can go one step ahead, get a competitive advantage, and make disclosures related to scope 3 also. That would be very great, but at least cover scope 1, scope 2, and so on respectively. Is targets. Okay, targets. So entities to provide information about the climate hazard, and so yeah. So sometimes, according to IFRS and according to the government, also they expect you to disclose about the targets and all. How well have you met the targets? What is the progress towards it? What are the strategies that you have applied for the same, and so on. So the company aims to reduce water consumption per occupied room. This is an example, okay? The company aims to reduce water consumption per occupied room by 20% from 20x0 baseline at the end 20x9 at the end of the reduction of water consumption per occupied since 20 was 8.4. We are behind schedule on this goal, but continue to expose what is reduce water consumption. Okay. So see, they are saying by 20% from 20x0 baseline by the end of, so by 20x9 they were supposed to meet this, they are supposed to meet this target. By the end of 20x6, they are only meeting 8.4%. So like there's still a lot to meet, and don't know if it is likely that they can meet it by 20x9. So the company plans to reduce net carbon by 30% from a 20x0 baseline. The to achieve it will reduce gross emissions by 10% while also making use of carbon credits. These credits are generated from projects that are use technology to capture carbon dioxide from the atmosphere before storing it safely underground. The carbon credits have been independently verified by, yeah, so 24% and 2% respectively, net and gross. We are behind, reduce on the close, but have implemented, yeah. So they are allowed to make use of carbon credits. So carbon credits are nothing. It's just sometimes if you have not met your targets, you can use the credits that you have bought already or you have invested in already. And those credits are, utilized, and therefore you can meet your target. For example, if your carbon emission has gone for 40% while you want to bring it back to 10%, you can buy the carbon credits enough to bring it back to the 10%. So you have to pay extra anyways. So it is better that you can be preventive, and to not spend extra, you will try to reduce it. You will already try to be preventive, you will already try to reduce it, keep it to a minimum, or at least meet the target somehow. That is set by the government. We are behind schedule on a gross rate, but have implemented new executive management share-based pay, which will vest till the goal is achieved. So they have kept there's a performance-based pay. So, or we can say, yeah, basically they are linking the targets to share ownership. So only if they meet this, if they implement this gross target, they have the proper strategies in place, they have the proper timing, proper schedules, proper timetables, everything in place, is that's when they can go and vest the share based payment. Or basically it means they can go and get the ownership of the shares in the company. They can become shareholders like any other shareholders. They can end up getting dividends or whatever it's going to be. So it's technically going to encourage them to best interest in the company or get the ownership in the company. That is like going to be like their drive. When we are interested in something, we really badly want it, only then we'll work towards the target. That's a psychological thing to do. So that's what company is doing here by performance rated pay. So it is a topic under corporate governance as well. Many areas it is covered. SBL exam also it is covered. Here also they have linked this in the scenario. They have linked it this way. If entities disclose the net GHG emissions to target, IFRS S2 also requires disclosure of the gross target. This is because a reduction in net GHG emissions can be achieved without making changes in the entity's business model, for instance, through the purchase of carbon. Yeah. So this is what I just explained, to be honest. If I retain as an emissions, and okay, first of all, learn the definition. A carbon credit as an emissions until that is issued by a carbon crediting program and represents an emission reduction or removal of greenhouse gases. So in the above scenario, we can see that it is a part of the program issued by a carbon crediting program. So Global Carbon Council has verified the credits. That means they have issued it. They are vouching for it. And secondly, it represents emission reduction. So uh, it is specifically for the carbon credits are specifically for those emissions which are related to carbon, right? So it is meeting the definition properly. So it is very important to know these definitions, not to learn them for the exam. No one's going to blatantly ask you to define and give the answer. They are going to test your knowledge related to how a carbon credit should be verified, whether the person knows that a carbon credit should be verified by an authority, which is, the carbon council or something, whatever is in the jurisdiction, and whether they know that the carbon credit is linked to emissions only, not for any other category of sustainability risk. So this is something that they will test you. This is something that you should be aware of. No one's gonna expect you to learn like board exams or childhood stuff. Now, IFRS 2 requires entities to disclose their planned use of carbon credits to achieve any net. Yeah, disclosure of the planned use of achieving is important because some carbon capture technologies may prove ineffective, or there might be a change in the regulations that ban entities from using certain schemes. So the prices of carbon may also change significantly, which will impact these plans and therefore the entities. So basically, what is the price that they have to take into consideration the price of these carbon credits and how likely are they to use these carbon credits. So, because what happens is sometimes if they feel that the market research shows that their technologies are not carbon supportive, carbon emission supportive, like they are really causing a lot of carbon emissions, if not now, in future, surely they will be, called out by the government, they will be banned by the government if they keep using these technologies, and they would have to end up using the carbon credits. They would have to mention that, they would have to give the reasoning, they would have to give a proper probability, they would have to give the actual estimate that they would be spending on carbon credits. And given the fact that carbon credits prices keep changing, keep varying based on, whatever is the demand, you know, uh, so, and plus the jurisdiction also. However, it is, trading and all of that, because I've heard that it's traded also. So it depends on that. So they would have to consider disclosing about that. And again, they can give that in the scenario where carbon credits will be mentioned and the disclosures associated to it. What is the why it is material to disclose it? This paragraph is a clear answer for that, and it's a generic answer, guys. The first scenario tests your generic stuff. Maybe like I'm not saying it is going to be like that, but most of the times it is going to be the generic stuff, not specifically related to the scenario. Only in the second part, the fourth question, part B, they will test you probably based on the scenario. They'll get deeper into the scenario. But first question is going to be like that, general. And even if it is not generalized, you should know how to answer. To be honest, you have read the article. Your article is going to help you answer the question. It's more than enough, to be honest. So no one's expecting you to calculate, guys. It's all about the answer and the knowledge which I just decoded for you. Now let's get to the other article that I read for climate change and IFRS accounting standards. This has many questions in the kit. I have personally seen that. I remember that as well. How a particular scenario of climate change has affected the other IFRS standards or how it will be applied. If, for example, an unforeseen circumstance, a fire incident has taken place, it has caused impairment, it has caused change in the valuation of inventory, it has caused change in the valuation of depreciation, the valuation of the PP, depreciation, income tax effect, all of these effects you should be knowing. Sometimes I feel that it should, first of all, logically come in your mind. These are the standards that are involved as per mentioned in the technical article. And besides this, also, if there is some other standard, you can be logical and answer. SBR is a logical exam. It is not by hearting, you will by heart the technical article also. No, it is a logical exam where you answer properly, where you answer based on your logic. If you give a proper explanation, you're good to go. Even if according to the examiner it is technically wrong, but if you have a correct explanation for the same, you're good to go, bro. So don't worry about that. And as I always say, 1 mark for 7 marks, or for example, if it's 6 marks, you have to write half. That means 3 points. So don't always go for this. 3 points, 2 sentences. So that makes up the 6 mark. And don't write bullets, of course. That's common sense. Write in like, no need of bullets. Just write the answer like that. Separate sentences and no paragraphs. So as well requires, yeah. So I'm pretty sure you get bored by me reading. So I'll just try to shorten it for you. First of all, presentation of financial statements, it's specifically, yeah, it's First of all, let's understand not present elsewhere in the financial statements. This requires disclosure of information that is not mentioned anywhere else, you know, in the financial statements, like all the other information out there, some other rest of the explanations and all, whatever is there. So if there's any material information that might not have been covered by even the climate related IFRS standard, this is what it's going to cover. This is what IS1 will cover. So disclosure of assumptions about climate made by, yeah. So what are the assumptions? Maybe in climate related disclosures, you didn't specifically mention the assumptions. You mentioned more about the market related factors that affected the this, or you mentioned how it has performed against the market with context to target. So you mentioned the strategies, but you didn't mention the assumptions, the financial part probably. Maybe your strategy is different, your policy is different. Your policy is to mention that in the IAS1. So you mentioned it under according to IAS1 presentation of financial statements, where other disclosures are made. So, for example, estimates of future cash flow for impairment testing for purpose of or the calculation of decommissioning obligations. Yeah. So all the other, you know, uh, sensitivity analysis made. How has ECL calculation been made? What are the factors that are there? So all the other information, extra information out there for the readers of the financial statements to be able to decode every part of financial statements and be able to make a proper decision, uh, unbiased decision is what matters. So in addition, IS1 requires disclosure of the judgments that have a significant effect. Yeah, exactly. Estimates, judgments, important to, help them figure out, the investors figure out if any significant, and assess a company to continue as a going concern. Yeah. So, so if there are some uncertainties related to going concern, for example, it's like I have seen scenarios. Sometimes it's not like there's total uncertainty. Sometimes only some uncertainties are there, some factors are there that could, you know, probably show that okay, this company is likely not going to be a going concern the next year or something, but it's not entirely proven. You would still have to disclose that in the uncertainties in the disclosures area in the as per IS1, and that can be caused by climate related stuff, right? Anything happened related to fire, your crucial assets have gone into fire, your crucial supplier is gone out of your hand, and so on. So whatever crucially affects your business can affect your going concern status. So here we're specifically, however, talking about climate related factors that can affect the other IFRS standards. So if in the exam you're asked what exactly, which all other IFRS standards are affected as a result, this is the answer. You can mention that this incident has taken place, that's how it will affect the financials, and this incident is specifically related to climate related matters, and therefore that's how the IFRS standard comes into picture. Now, each IFRS standard that is usually asked is explained here, properly decoded for you. It's so easy for you guys to pass this exam, to be honest. So, because more than half of the information, everything is covered in FR. FR is the main paper. So, climate related matters may cause a company's inventories to become obsolete. Yeah, to be valued lower of cost. Yes. So, basically, your NRV may change. Yes. So, NRVs may change, selling price may change. You would have to discount and sell. And when it is discounted, that means you have to check whether NRV has become lower than the cost. If that is so, you will have to value the inventory accordingly. That means you will have to write down the value of inventory to the NRV, right? If NRV has gone below the cost, net realizable value is what is NRV, by the way. So this is what it's saying. If climate related issues have caused that thing to your goods, for example, climate related factors have destroyed the demand for your goods. Now you were more into summer season. You had started selling that, but suddenly there was a weather change. For example, in the UK, there are some stuff like that. So there's uncertainty related to climate stuff. So again, if that happens, your inventory values will change, of course, because the demand has fallen. It's kind of cold again. So that means your demand for summer clothes will go down. So as a result, your inventory NRV selling price will come down. You will have to discount and sell it to customers out there, right? So that's what it's trying to say, that you would have to disclose the effect of that on this IFRS standard, like what exactly you will do under this IFRS standard, or you should be knowing that these all IFRS standards will be affected. Then IS2 income taxes. So companies should recognize deferred tax assets. Yes. Probably the future. Yeah, yeah. So it's saying that yeah. So if, for example, usually we have everywhere read it that whenever you have got enough, only if you have got enough future taxable profit is when you can, utilize those tax losses that you have previously recognized as deferred tax asset. If you know income tax IS12, you should know what I'm trying to say. So only if those future profits are there against which we can, offset the tax losses. If that's not there, then what will we do? So that deferred tax asset itself will be written off. So that's what climate related thing can do to this. Climate related thing can lead to future taxable profits being affected. Of course, your future taxable profits are probably based on estimates, right? You can't clearly say that whether you will be profitable. These are all estimates, these are all assumptions. So what we are trying to do here is we are trying to assume. So we also have to consider the scenario if climate related change has happened today. In future, what else can happen? In future, do you think I'll have the same demand for my products? If not, that means I can't expect future taxable profits to be same. They will reduce. And that therefore that means that my tax unused losses won't be offset by these profits. I won't have enough profits to offset them. So therefore you have to check the effect on this IFRS standard as well. Then IAS 16, this is easy. By now you should have understood to review the company's residual value and the useful life of an asset at least at each financial year. And if expectation differ from years, any change should be accounted for prospectively as a change in estimate. Climate matters may affect the estimated residual value and expected useful life of assets because of obsolescence or legal restrictions of their use. So मैं खत्म करूंगी उसके बाद नया यार at least at each financial year. So at every year end, they are supposed to see if first of all it's not a change in okay. So IAS 16 useful life will change. I have already told about this in the start of the video. Useful life may change. Your assets won't be the same, won't have be the same use anymore. They are deteriorating in value. N number of reasons. Your production, they are not, they are, their condition has deteriorated. There's a lot of wear and tear. They are not producing as per the demand. So many reasons. They are just not performing as per the mark. So what does that mean? That means that there has to be a change in useful life. The useful life will reduce, which means that depreciation expense will increase, and that means higher expense in operating, and then that means lower profits. So you have to mention all of this. How exactly will it affect because of the useful life reducing, and it's a change in accounting estimate. You should know this also. This is IASA topic. If depreciation useful life has changed, that means it's a change in accounting estimate, not accounting policy. So we'll have to prospectively act for it. So if it would have been a change in accounting policy, then we would have retrospectively, that means in the past year also we would have restated. But here nothing, all of this is not there. So you will have to change the accounting estimate, that is in the following year, in the current year, you will have to change it. You will have to record a new depreciation, and that is under accounting estimate. Then IAS 16 is done. Okay, IAS 36. So this is very easy. Of course, decline in the environmental friendly could indicate impairment of that product. An adverse change in the business environment of a company is an indication of impairment. In addition, value in use a company is required to calculate cash flow projections based on reasonable and supportable assumptions that are the best estimate of future economic. These companies will need to consider whether climate related matters affect those assumptions. Companies are required to disclose the event circumstances assumptions that led the regulation. Yeah. So basically, three things are there. They will have to see if there is an impairment indicator. That is a separate topic heading under impairment chapter in FR also. They could indicate impairment. An adverse change in the business environment of a company is adverse change in the business environment, decline in demand because it's not environmental friendly, For example, if they get to know that the supplier from which you are getting the products are actually not treating or they are conducting the practices of child labor, which is unfair, they will not buy products from you. Your products will also go in a toss. Your demand will go away. So this is what I'm trying to say is that you will have to check if there's an indicator of impairment. Second thing, of course, you have to do the value news and versus the carrying value testing. So value news, if value news is higher of value news and this fair value less cost to sell, okay, that will be compared against the carrying value of the asset. If carrying value exceeds that, that clearly means as an impairment. So this testing has to be done. This is called the impairment testing, guys. You should know about these terms. So thus companies will need to consider whether climate related matters affect those assumptions. Okay. Then climate related matters, yeah. Then companies are required to disclose their event circumstances, yeah. So again, when they calculate the impairment, why exactly? What was the indicator? What were the events that led to the recognition, which could include climate related events as well. So if it includes the climate related events, what disclosure they should make, that also you can include, you know, based on what you just read about climate related disclosures. So you can include that. I mean, if that's enough for the mark, or you don't have to be extra. So I guess 37, then it's talking about, again, if you have not met the targets for the climate related matters, there could be penalties. You would have to record a provision for the same. And if, you know, your inventory purchasing or redesign, your product redesign has taken place, and that means that your current products will become obsolete. Your inventory is not useful anymore. You're not going to sell that anymore. It's not going to be of use anymore. So you will, have to redesign it according to a technology which is not going to produce carbon emissions. And because the government has banned the technology that you were previously using, so that would mean that onerous contracts will come up. Onerous contract is another topic under IS 37, and that would have to, we have to record that operating losses and all will increase and all of that. So you should know about this. You should know how exactly what all categories under IS 37 will be affected. But it is suited to the scenario, guys. Don't end up writing all of the onerous contract penalties, all of that. Don't end up writing all of this. Only what is relevant to the scenario in the question is what you have to write. For example, if fire has taken place, write according to that. If there's a penalty that is there, write according to that. If they have not met the target, write according to that. Don't do extra. No need to do that. It's just time waste. So companies should disclose major assumptions about any future events that have affected a provision or a contingent liability. So if they assume that a future event can take place and a contingent liability is therefore coming up, or if a provision is likely to be created, they can mention that as well. Then IFRS 9. So it has got a lot of paragraphs. So let's matters may affect a lender's exposure to credit losses caused by environmental disasters or yeah. So basically, there's a lot. If the company has lended someone, they would have to, or if there's a receivable, yeah, lended someone receivable or whatever, it's the same thing. Their calculation of ECL will affect, right? Initially, they just recorded a 12 months loss. Now they have to record expected credit time losses because the borrower is clearly not able to pay. He is going to default for sure. And that is happening because climate related matter has affected his business. Some disaster has taken place. So you would have to assess that as well. It's not like the disaster has only affected the borrower, it has affected you as well. You will have to increase your ECL, which means you will have to record a higher expense, and therefore your profit will also reduce. So you should know the impact that way as well. The classification and measurement of loans may be affected as lenders may include terms linking contractual cash flows to increase achievements of climate related. So whether contractual or the financial give rise to cash flows that are solely payments of principal and interest on the bill, if they have got they would have to see, yeah, okay. They can only, first of all, solely, yeah. The lender would need to assess whether the contractual terms of the financial asset give rise to cash flows that are solely payments of principal and interest on the principal amount outstanding. That is the contractual cash flows, that business model thing. That is according to IFRS 9. There should be this contractual cash flows thing, and and you should not be selling the financial asset, trading it, and then you can recognize it under OCI, right? That's the thing. That's the rule. And I mean, it's all about the treatment. That doesn't matter. What matters is he links the contractual cash flows to a climate related target. That means he will only recognize it as an asset, or only recognize the fact that borrower has paid on time if he has met the sustainability targets that were set up in the contract as well. So this is going to affect his financial asset status, the lender's financial asset status. So if I set up these targets and I find out that they were not met by the borrower, they have not met the lending terms, they have not met the reason behind why they had taken the money from me, that means they have not clearly met their targets, and I'm not going to record a financial asset. Therefore, there's a breach that has taken place, even if they pay me on the cash flows on time. Secondly, sometimes embedded debt needs to be separated from the host contract. So what happens is embedded derivatives are where there's a host contract, okay? And for example, if there is a loan amount, okay, this financial asset will become the underlying item that is hedged, okay? It will become linked to a derivative, okay? We are going to the derivative is basically formulated because there's actually an uncertainty if it's like a hedge. There's an uncertainty if the borrower is going to meet the target or not. Okay. So we are embedding that uncertainty, that targets that are set up. That is a derivative, that target. And the item, what we say, the host contract is the loan item, the financial asset for the lender. Okay. We mingle these both up, okay, so that the lending takes place according to climate related targets. Okay. Now what happens is we account for them together. Like we consider the accounting for them together. But if the thing happens that the climate targets are not clearly going to be met, there's uncertainty surrounding that. There's a high probability that it's not going to be met. Therefore, what happens? You will have to separate these two. They can't be embedded anymore, only until the possibility or the probability that okay the company borrower was going to fulfill the targets, only till then they were embedded. But as soon as we got to know that they can't do it, we will separate the accounting for both. For derivative it will be accounted according to IFRS 9, like whatever in the PNL and all we record change and all. And while for the other one we record according to its normal amortized cost accounting, whatever it is. So basically, it's trying to say that these both will separate. The climate related targets, if not being met, it will also affect the embedded derivative accounting. Right? So we should know about this as well. This is clearly covered in the SBR chapter. Then it may reduce the probability of a hedge forecast transaction occurring or affect its timing. In this case, the hedging accounting may need to be terminated or they may be added. Yeah. So of course, if you know in depth about hedge accounting, you will know about all this fair value hedge, cash flow hedge, all of that. So if, for example, it's unlikely because of the climate event, that in the future the transaction will take place. Therefore, what you will do? There will be hedge ineffectiveness, or they may have to, you know, whatever gains and losses they had recognized in relation to the hedge, they would have to restate it back to the PNL, and they will just let go of the derivative, and because the transaction will never take place, right? And why it is saying hedge ineffectiveness is because actually it gets more technical here. You don't have to see so much. What happens is sometimes I think they would end up hedging more or hedging less. Yeah, what happens is if a transaction is, say, let's say $1,000, okay, the company is going to receive it and they have recorded cash flow hedge accounting that they have done for it. Now it is likely that they will only get 600 because of the whatever uncertainties are there in the environment. Maybe disaster related event has happened and the person can't pay, the buyer can't pay you that much anymore. So 600 is the only amount that we are going to get. Hedge is still there, but hedge is not going to be now for that 1000. Hedge is going to be for that 600 only. Okay. But we had hedged for that 1000 initially. So that became an overhedge, right? Now we are only going to hedge 600 with that 1000 contract, 1000 derivative contract. That is overhedging. So that is our concept of hedge ineffectiveness. Hedge is going to be ineffective and we'll only account for the part which is likely to occur. That is at 600. Remaining 400 will not be recognized in the PL. Remaining 400 actually will not be recognized in the OCI. It will not be recognized in the cash flow hedge, because cash flow hedge says you should recognize in OCI, right? The gains and losses. And then you should restate once the transaction occurs. But in this case, the extra, that 400 part, won't be recognized anywhere. Whatever gains and losses were there related to that will be restated back to PL. And therefore, that's how the ineffectiveness will go. But any which ways, it depends on the scenario. You don't have to write all these points, but I'm trying to decode it for you. Please tell me in the comment section if you want me to decode it further. And if you understood it, please just ping me in. Finally, IFRS 13. Again, this has 3 paragraphs which we have to decode. When making the critical assessment judgments by information, the analyst should consider what conditions and the corresponding assumptions were knowable or knowable to market. The impact of climate change on fair value measurements would depend on the evaluation of whether the climate change would have impacted market participants' valuation assumptions at the reporting date. Okay. So, if you are going to consider the, of course, when you find out the fair value of a particular asset or liability and at the reporting date, if you recheck your fair value, if there's any significant change, or if you have a revaluation model, for example, if you check the fair value, then you see there's a significant change now that climate change has happened. So, of course, you would have to account for it, right? You would have to check that. Then information such as climate-related legislation is available, maybe in making relevant in making this evaluation. This would include any corroborated or contrary evidence such as the timing and trajectory of observable market price movements of trade assets in the relevant markets, as well as information from the source of market data after the reporting date. So, I'll just state exactly what might be a particular incident that led to the market deciding such price movements for the asset for the particular industry. For example, fashion industry is there. It's a summer season going on. You expect a significant weather change, right? And you don't really expect summer to stay anymore. Of course, the demand of the products will go down as a result and so on. And your assets will also probably, or maybe if there's a significant change related to the legislation, the technology that you're using for producing the garments and all, that's banned because of climate related concerns. So that can also affect the industry significantly if most of them are using the same machinery, similar machinery. So that is what is this covering. The asset value will fall, right? And it's because of all these events that I just described. These are market related events which you can give the evidence for. Like this is research article, some news article that has happened, some from a reliable source, of course, that you can give as evidence to the investors, disclose as evidence to the investors. And that can also be useful for telling about your assumptions and inputs that we're using the FM. So basically there's level 1, level 2, level 3 inputs. Level 1 is the most correct one based on the principal market actual value. Level 2 is similar for similar assets. Level 3 is full assumption estimate and all. So which level have you used, what input have you used, and why have you used that? Give the corroborative evidence from the market data. So basically it's just that, and suit it according to the scenario. Basically it's just that. So then it's saying about how why it is important to meet the disclosures, both financial, non-financial disclosure requirement for investors, non-investor category, every stakeholder category, and all that. Yeah. So see, this is not exclusive, but are indicative. Usually, it is that what I said starting me. This only I said. These are not the exclusive list of IFRS standards which may be effective. Something can be more beyond this based on your knowledge. So, which is why I'm saying brush up your knowledge into IFRS standards and keep yourself updated about this, please. Okay, I just realized, did I miss contingent? No, I didn't miss contingent. So I did everything. Yeah. Okay. So let's do a question, recent question. I would say that would be better to help decode further because practice always makes a man perfect. Practicing such questions, I mean. Stop share.